Discover how international agreements prevent financial burdens and foster economic growth, a critical insight for anyone engaged in cross-border activities. This comprehensive overview explains the intricate process of establishing Double Taxation Conventions, DTCs. In an interconnected global economy, businesses and individuals frequently generate income across national borders. This often leads to the complex challenge of double taxation, where the same income is taxed in two different jurisdictions. Such scenarios create significant disincentives for international trade and investment. Leaders from Nation A and Nation B recognize this impediment, stating, "A sustainable solution is imperative to alleviate the burden on our constituents and foster economic collaboration." The journey begins with high-level preliminary discussions between finance officials from the involved nations. These initial meetings establish a shared understanding of the economic challenges and mutual objectives. Minister Lee, Nation A, articulates, "We aim to encourage robust trade and investment, yet double taxation undeniably acts as a significant barrier." Minister Silva, Nation B, responds, "Let us strategically explore a treaty framework to resolve this. We will establish a joint working group." The joint working group, comprising tax experts and legal professionals, often consults established international frameworks, such as the OECD Model Tax Convention. These models provide a standardized template for treaty provisions. A tax expert explains, "This model serves as our foundational blueprint, detailing income types, definitions, and dispute resolution mechanisms. We can adapt its principles to align with our specific national economic and legal contexts." The negotiation phase involves detailed discussions on critical aspects like tax rates, residency rules, and anti-abuse provisions. Each nation seeks to protect its tax base while promoting cross-border economic activity. Tensions may arise as representatives advocate for their national interests. We seek a lower withholding tax on dividends to attract foreign capital. However, we must safeguard our domestic tax revenues. Compromises, such as phased reductions, are often proposed to bridge these differences. Following successful negotiations, legal and diplomatic teams meticulously draft the final treaty text. Every clause and definition is scrutinized to ensure clarity, precision, and legal enforceability. The climactic moment arrives as the finance ministers formally sign the new Double Taxation Convention in a public ceremony. This act signifies a binding commitment between the two nations, marking a significant diplomatic achievement. The signed treaty must then undergo a rigorous ratification process within each country's legislative body. Lawmakers debate its implications, assessing its fairness and potential economic benefits for businesses and citizens. Upon parliamentary approval, the convention officially enters into force. This final step integrates the international agreement into domestic law, making its provisions legally binding and operational for all stakeholders. International economic landscapes are dynamic, necessitating periodic reviews and updates to existing DTCs. Officials from both countries reconvene to address new challenges, such as the taxation of digital businesses. They agree on protocols to amend and modernize the convention, ensuring its continued effectiveness and relevance in evolving global commerce. This proactive approach maintains the treaty's utility for investors and businesses. Through diligent negotiation and sustained cooperation, countries can effectively bridge fiscal gaps, stimulate international investment, and ensure equitable taxation. A well-structured Double Taxation Convention is more than a legal document, it is a vital gateway to enhanced global economic prosperity. Take action, understand how DTCs impact your investments, business operations, or legal practice. Consult official government resources or a qualified tax professional to explore specific treaty benefits and obligations relevant to your cross-border activities.